All right, guys, so it's true. I just bought 100 shares of one company inside my $8,000 or so portfolio. In this video, I want to talk about why I chose that one stock, what my strategy is with that 100 shares, and why you might want to consider it as well. I'm not going to waste any time, guys. Let's dive right down into the portfolio and get right into it. The stock, guys, is AT&T. Ticker symbol T. And I know what people are going to say, and I'm definitely going to talk about their debt issues. There's a lot of people that talk about AT&T. I'm going to get to all that. Also, too, for those that want to debate AT&T versus Verizon, please know that I also own a very small fraction of Verizon. Guys, if you see my total portfolio, you can see I don't really own a lot of shares of a lot of stocks. All right, I've built it to about 22 stocks right now. But right at the top, you can see that I'm starting to build up 100 shares of my lower priced items. The reason I did it 100 shares with T and not Verizon, I like T long term, definitely as a dividend stock over Verizon, and I'll give you the answers why. And also the share price. It was easier for me to get to 100 shares at $30.16 as it is at $55.87. Okay, so why did I buy this? When I first started my portfolio, I figured I was going to add money to it over time and I was going to build everything up together. Then I remembered back in the day when I used to do something called the wheel strategy, where I would sell cash covered puts and covered calls to collect premiums. It's called the wheel. I've done a video about it. I'll put both those videos at the end. It's an options trading strategy, and it pretty much allows you to collect passive income on a weekly basis. For those of you that have been watching the channel know that I've been doing this with Wells Fargo over the last couple of months. In June alone, I made over $100 in premiums using options trades and just cash covered calls with Wells Fargo, and I wanted to do the same with another stock, so I chose AT&T. And I think this is going to be the strategy that I'm going to use moving forward. As opposed to building them all up, I think what I'm going to do, because all of these companies I really find value in, I want to own all of them. I've done my research. I've done videos on every single one of these. You can go back and look at that playlist. So what I'm going to do now, I think, is I'm going to start with my lower price stocks and I'm going to start purchasing them up and get them each to 100 shares so that I can continue to collect those premiums. And at the end of this video, I'm going to show you exactly what I'm talking about because I have not made any options trades. It's Monday, the day this video is coming out. Right now, the market's just open, so this is about as live as you can get. If we click into AT&T, you can see they started off low. Over the last week, guys, they've been on a little bit of a dip. We can see this. Over the last month, they've been doing about the same, down about 2%. But you can see, guys, even at down and up, and their stock price does not vary too much. We have just about $33 here, and we dropped to about $26 here. That's over the last 3 months. Over the last month, we have highs in the neighborhood of $33.23, and then they dip down pretty much to 30. So they're pretty much trading in that zone. And you can see over the long term, guys, I will be the first to admit this is not a growth stock. This is a dividend portfolio play. In no way, shape, or form am I going to talk about how they are growing exponentially and their share price is going to be $1,000 one day. That's not the strategy for AT&T. So my average share price is $30.15. And remember, when we're selling cash covered puts and we're selling covered calls, this cost basis is going to be the benchmark for figuring out what kind of strike price we want to do, which is going to affect our premiums. So this number to me really is important. As Robinhood always does, they give you some information down here at the bottom. They give you a little brief summary. Market cap 215 bill, PE ratio 15%, under the S&P 500 right now. Dividend yield 6.8. I always cross-check this, guys, with multiple websites. Let's just go over to Seeking Alpha. See exactly what Seeking Alpha has to say. So dividend there right there as well. So pretty accurate, 6.86%. A very, very good, strong dividend. So $2.08 per year. Payout ratio, 64.77. That's good. All right, I'm looking for something under 75%. And with that payout ratio being 64, especially with all of the debt they have, full disclosure, I know how much debt they have. I'm going to talk about it in 1 second. 64, I'm super happy with that. 5-year growth rate, okay, 2.09%, not the best, not the worst. And these are a dividend aristocrat at 35 years of continuous dividend growth. And once I said, guys, this stock is all about stability. It doesn't have a lot of volatility at all. It's not going to be shooting up. It's not going to be going down, which also makes it great for selling covered calls. We can look at a couple other things on Seeking Alpha that I like to look at. This dividend yield has a great upward trend, meaning the dividend is rising faster than the share price. This is a good thing. ascending. We want this graph here to be at least level. We never want it to be going down because that means the stock price is going up, but the dividend yield isn't going up with it. So we're seeing this upward trend. Yeah, a little bit of dip here with what's going on in the world. That's okay. But we can see a general upward trend, and that is a good thing. Here's that dividend growth we see. Okay, all the way back to 96. It's up and up and up, even with their debt. This is when they acquired most of their debt right here. So we haven't really have a lot of data to see exactly how that's going to affect their revenue long term. But like I said, I'm going to talk about it. I think it's okay. We look at the dividend history. And once again, it's exactly where I want it to be for a dividend stock. Before I talk about their debt issues, let me just show you what I'm talking about with their options trading. So if you saw my video about selling covered calls, you will know that you need 100 shares of collateral as opposed to selling a put where you need to have the collateral in cash. That's why they call it a cash covered put. So we see right here the strike price. Now, to be honest, today I'm not going to buy an option with them. Generally, you're going to want to sell your covered calls on up days, green days, when the price is going up. Today, that is not the case. And what that's going to do is just going to directly affect the premium. So with an expiration date of June 26th, I could pretty much wait maybe Monday, Tuesday, Wednesday. I'll check it out. If it goes in the green, then I'll start to make that, because this right here, this premium price is going to go up. And like I said, if I go back to my basis of $30.15, I need to make sure that I choose my strike price above that, because if I get assigned and those get called away from me, I want to make sure that I make some capital gains profit. So I'm only going to look at strike prices that are above $30.15. So if we go back and I say sell a call, $30.15 is right here. So I can choose anything over this, and I'm going to sell for a profit if I get assigned. Now, if it keeps going down and it gets worthless, these would be the premiums that I'd get. $30, pretty close to the share price right now. This would be $15, $8, and I'm saying $8, $15 because these are all 100 share contracts, remember. So this 8 cents is really times 100. So I would probably try and go a little bit above. It depends. You can choose your percentages, but I know that right now, if this goes up 50 cents or so, these premiums are also going to go up with it. So I'm not going to do that today. The same holds true if I go back and just look at my other one real quick, which is Wells Fargo. Wells Fargo is right now way below my cost basis. $27.37 is the current share price. So for me, I need my strike price to be above $32.66. So if I go to sell a call at $32.66, right now I'm looking at making $3. So like I said, it's $3. I'm not going to step over it, but I can wait Monday, Tuesday, Wednesday, see if Wells Fargo comes up. As the share price approaches the strike that's going to make me a profit if I get assigned, then I'll collect those premiums. I usually will make my decision by Wednesday. Somebody asked me in the comments the other day, why am I going with 1 week? Why don't I go with 2 weeks? I'll show you what I mean there. That you could choose different expiration dates. If this is this coming Friday and then the Friday after. Generally, what I've seen is that if you choose 2 weeks, it's not double the premium. Sometimes it does happen. For example, $32 right here. This strike price is going to give me $4 by this Friday. So for it to be worth it, if I waited 2 weeks, it would have to be more than double that. So if I go to July 2nd, and look at that $32, it's $11. So that might be a good deal. That might be something that I would want to do. This would be a case in which I would choose a 2-week expiration because I'm getting more than 2 for 1 for my premium, but it's only double the time away. So that's something that I might look at as I look deeper into this over time. Now, as far as AT&T, the company goes, I did a deeper dive of AT&T and why I wanted to purchase it a couple weeks back when I just bought 1 share of it just to get it into my portfolio. So if you want to go back, I'll leave a link for that. You can go back and see a deeper dive. But I did want to talk about the debt because in that video, I don't think I was clear about how I'm okay with their amount of debt, and people comment all the time. That's awesome. Thank you so much for commenting and asking me questions. I learned so much from you guys. So if you have any questions about any of this, just get down in the comments and leave me a question and I'll answer it. I pretty much answer every single comment. So with the debt that's going on with them, there's been a lot of changes inside their company, and right now they're leveraging debt. And what I mean by that is I think they're using good debt. Now, the whole good debt, bad debt, If you know anything about small business, sometimes you need to leverage debt. You need to take on debt to increase your revenue or to change the future projection of your company. I'll give you an example. I'm in the beer business, okay? So I was paying somebody to come to my facility and to can my beer and to bottle my beer. And I was paying them a pretty big price. But at the volume that I was canning and bottling, it made sense not to buy a $150,000 to $200,000 system. But over time, the amount of volume that I was producing pretty much got to that break-even point. So what we had to do was we had to purchase a $200,000 canning line. That put us $200,000 into debt. But on the bottom line side, it raised our revenue immediately yearly at $50,000 right in the first year alone. So if we did not increase, it would take me 4 years to break even on that purchase. So if you just looked at the debt, you'd say, wow, these guys are donkeys for taking on $200,000 worth of debt. But from the inside, we knew that we were really creating $50,000 more of revenue at least in year one. And that was going to go up as our volume continued to go up and as we continue to can and bottle more. That's essentially what AT&T did here. The first big one was in 2018 when they bought Time Warner for $85 billion, okay? $85 billion is a ton of debt, but by buying Time Warner, they set some other things in motion. And those other things in motion created more debt as well. But once they're done setting up that infrastructure, the future of their company is looking really, really good. And here's what I mean. So on top of that $85 billion, they just released HBO Max. HBO Max cost them another $4 billion. So now that's $89 billion just with HBO Max and acquiring Time Warner Media. With HBO Max, they spent $425 million getting shows back that were on Netflix, that are no longer on Netflix, that are now just on HBO Max. So right there, just with that one move, that's $90 billion worth of debt. And I think they're going to make that back. I think HBO Max is going to do very, very well for them. And people want to knock HBO Max. They say it's really expensive. It's not expensive. It's the same price as all of HBO's other subscription services. And nobody ever said like HBO Go is too expensive. Like it's in line with what they provide. I've also seen them knocked for their subscriber size. Right now, they plan by 2025 to have between 75 and 90 million subscribers worldwide. And people come out and laugh at that and say, well, look at how many subscribers Disney has and look how many subscribers Netflix has. That doesn't really matter to them too much. That would be like me worrying about how many subscribers like Graham Stephan has. Like comparing myself to Graham Stephan. He has almost 2 million subscribers, and because he has 2 million, my 15,000 subscribers means nothing. That's not true. 15,000 for me works out just fine. And they're thinking about it from a revenue, from a margin, and from a profitability state. If they get to that 75 to 90 million subscribers, that's going to be good for their business regardless of how many other subscribers the other subscription networks have. I'm not worried about how many subscribers Disney has. I'm worried about, does AT&T have enough subscribers to sustain the business model that they want? And currently, their projections say yes. They're also doing some other amazing things. They're trying to liquidate some of their assets and try and pay off that debt. They've said that they are attacking their debt. They know it's a potential problem, but they don't seem too worried about it, and I'm not either. They have things like 5G, and 5G, I'll give 5G to Verizon. They are ahead of the curve. But once again, it's the same as a subscription basis and comparing yourself to other platforms. AT&T does not need to have more 5G service than Verizon. Right? They just need to have enough to reach the margin, the profitability, and the revenue that they need to succeed as a company. They're also trying to liquidate other things like their gaming. They own Mortal Kombat. They're trying to get rid of that and sell that off. And they're also lowering the amount of direct line telephone service, right? They started as the American Telephone and Telegraph Company, right? With no more telegraphs, and probably one day there won't be any hardline telephones either, but they are making that move. They understand DirecTV they're losing money, and that's pretty much a hole in their bucket, and they're making moves to try and potentially sell DirecTV and lower those amount of subscriptions. Like I said, they're doing the right things, and they're doing what they need to do for the future. Maybe right now things are a little bit rocky, but in my dividend portfolio, I want to hold stocks that I could hold for a very long time. So like I said, I'm pretty comfortable with with the future of AT&T. That's why I bought 100 shares of it. That's why I'm going to be selling covered calls, collecting premiums, and just raising up the dividend portfolio and increasing my passive income over time. If you're new to the channel and this video gave you some value, consider giving it a thumbs up so the YouTube algorithm knows it was good stuff. And also consider subscribing, hit that bell notification so you get told every single time I release a video or go live. Here's those 2 option videos that I made about selling cash covered puts and covered calls. And here's a look at my entire dividend portfolio for all of 2020. Until I see you guys on the next one, stay positive, work really, really hard, always. Be kind to other people. I hope you have yourself an amazing day and an even better tomorrow.